As we stand here today in the summer of 2020, there's a lot of just terrible news, a lot of bad things going on in the world, and in particular here in the United States. And in today's video, I thought I'd shift gears just a little bit to discuss financial health, specifically financing for a mortgage for the purchase of a property. Because despite all the bad things that are going on in the world, everybody needs a place to live. And typically you can only do one of two things. You can rent somewhere or you can buy a property. Now, when you rent somewhere, it's good and bad, and the same thing with buying. There is no better solution. It really depends on the goals and objectives and the financial condition of the individual or individuals that are considering buying or purchasing. And specifically, I'm referring to objectives and goals and plans regarding how tied down do you want to be to a particular geography, how committed do you want to be to a particular home, a particular location, a particular neighborhood, and are you okay with entering into a long-term financial commitment, which is what a mortgage is. It doesn't matter that you have a good job or that you're making good money. You can still qualify for a mortgage and qualify to buy a great house, but if you don't really fit the profile of a person that is suited for home ownership, then you're not going to be happy. So try to figure out, are you the kind of person that likes to or wants to at least keep their options open with respect to experimenting, exploring other places to live in the near future? And do you want to be open to the possibility of taking on new employment opportunities across a wide variety of places around the country? If so, then renting isn't a bad idea because it keeps you mobile. Whereas home ownership, it's great to own a home, but there are some things that go with that, and that is you're not as liquid because you can't just up and sell your house to move, very quickly. It does take time to do so. And when you sell a property, you have to be mindful of the fact that there are heavy fees in order to sell a property, regarding realtor fees, maybe some settlement charges when you move into your other home, or just moving fees as far as moving into another home and setting all that up in advance. Whereas when you rent, you'll have moving fees, but depending on the situation, you may find rental properties that are fully furnished, and if they're not fully furnished, then you'll have similar moving fees as to compared to buying a home. But the thing about rental properties is you don't have the same expense. Typically, you may have to pay a few $100s or a month to 1.5 months security deposit, roughly, give or take, to get into a rental property, to rent an apartment. And when you buy a home, there's the matter of a down payment, closing costs. It's a lot more money, a significant investment, an upfront investment on your part that is inevitably gonna tie up your cash and put you in a position where you just can't be that mobile, because you don't want to be spending all this money and then moving in a year, potentially compromising your equity position, because you may have to sell at a loss or a break even, and you're never a break even because you got to pay realtor fees again, and it just takes time to sell. Plus, the person that buys your property, even if you find the right buyer at the right price to sell your house, you still have to worry about their schedule and their ability to get a mortgage or financing to buy the property, and they may not be ready to close right away. So it's just a situation where home ownership requires a more of a stable, plant roots, settling down mindset, as opposed to renting, where you might still not be a person that has moved around a lot, but you want to at least keep your options open and keep your upfront costs low. And it doesn't have to be moving to like another state. It could be as simple as you just want to try out a neighborhood, try out a particular part of a state, And if you don't like it, you just move across town when your lease is up. Because remember, leases they could be month to month, but typically you're gonna find them 1-year leases are a pretty good standard offering out there. Whereas, and even 2-year leases. But at the end of the 1 year or whatever your lease term is, you can just move out. It's no problem. You have no issues with your credit. You fully fulfilled your obligation. With a mortgage, if you have, with home ownership, it's a great thing to own a home, but you're not going to be able to just pick up and move so quickly. It's going to take months, and it's not uncommon. And you can ask realtors about this. It is not uncommon, depending on how much you're asking for the property. It's not uncommon to have a property sit on the market for 6 months to a year or even longer, depending on the market. And there's no guarantee that when you go to sell your property, that values are going to be in line with what you paid for it. It has happened in the past. Who knows if it's going to happen again? But there's been cases in the past, and not too long ago, where people have gone to sell properties for one reason or another. Maybe they couldn't afford them anymore, the economy went bad, or they just decided to move and relocate. But they had a problem, and that is the property values went down below what they paid for it. And they were basically underwater on the value, and they were kind of stuck in the position, and they couldn't move. So they couldn't relocate to take advantage of a wider pool of job opportunities, or just to relocate for whatever reason. But again, home ownership is good, so is renting, but keep in mind that mindset, which are you, and proceed that way. That's probably the best advice I can give you as far as choosing one or the other, because neither is best. It just depends on your situation. Now, I wrote some quick tips here because I want to kind of make this video revolve around kind of how to qualify for a mortgage during health and financial crisis, which unfortunately we are here in this situation globally, and again here in particular in the United States. So first thing is I want to cover is this is really about primary residences, not commercial property. So primary residential property. So your family is going to move into a house, and it's going to be a 1 to 4 family house, not a 5 family or higher. You're not going to own a building or a warehouse, and it's not going to be for commercial use or commercial property of any kind. This is just 1 to 4 family residential, and it's again, it requires cash. Like I said, cash to get into the property. You have to pay a down payment. Typical down payment has been 20%, but you can definitely get a mortgage very easily for less than 20%. I just said 20% because typically a lot of people kind of shoot for that number because you don't have to pay private mortgage insurance, which is an additional cost if you pay less than 20% down payment. Now, you can get into a house with 10%, 5%, 3.5%, and maybe even lower. It gets more difficult and more rare to qualify for those reduced down payment programs, but you can get 3.5% on a government loan that a lot of banks offer, and you should be fine. I mean, it's a good mortgage, they're good rates, so nothing crazy about them. You can get them in most of the major banks. The other thing I want to talk about is the cash that you have, obviously for down payment and closing costs. You need to keep in mind you want to have enough cash also for your financial reserves. You don't want to get into a situation where you put all of your funds into a down payment, because then you're not going to have any money after you close. That's very dangerous. I think everybody kind of knows that you want to have funds for a rainy day. You never know what could happen. The boiler can break, the roof might need repair. Some things may be covered under insurance, some things not, who knows. But you could lose your job or have a temporary income disruption. That's possible. It's the sign of the times today. And you don't want to have zero money in the bank. You want to have as much money as you can with you in cash. Cash is king with you. Just you got to be the judge as far as how much you want. I mean, you want 6 months of expenses, 3 months, a year, the more the better. So that's why I would say look at some of the other down payment options. Don't just look at the highest down payment option that's offered to you. find out, are there lower down payment options? And the reason being, even if your mortgage payment is going to be a little higher, if you can keep thousands of dollars more in cash in your pocket, that may not be a bad thing, depending on your situation, so that you're not broke after you buy the house and something goes wrong. The other thing is job and income. So obviously the banks are going to look at not only how much cash you have. By the way, cash doesn't mean just dollars in your hand, in your pocket. It means money that's sitting in a bank account. Okay, those are the type of funds that banks recognize. If you have any type of large cash sums that are maybe put away somewhere that you acquired over the years from gifts, relatives, or whatever, what I would suggest, put them in a bank account, put them in the bank, deposit them, and wait a few months before you start applying for a mortgage, because banks are not gonna look at or consider cash money that just comes out of nowhere. Okay, so it's gotta be fully documented, and if you get a gift, that can be totally fine as well, depending on the mortgage program, but the gift has to be fully documented, and it has to show that that money is coming from somebody else's bank account, and you may have to provide evidence of that in the form of bank statements and just a letter that it was a gift and doesn't have to be repaid. The other thing is job and income. You need to have a job. So if you don't have a job, or you're about to quit your job, or you're about to go out on your own in your own business, but just before that you were employed by a company, that's a big red flag. You're gonna have a big problem getting a mortgage because you typically need to be employed, right? Common sense, right? You typically need to be employed, yet need to have a job, a steady job. Safe harbor, meaning you're not gonna have any problems regarding income. Regarding your job, is if you've been at the same job for at least 2 years. If you're at your job at least 2 years or more, that's gonna meet the requirement of stability. And if it's a salary, even better, because it's kind of easy for the bank to understand your income and how stable it is, because it's a salary. The other thing is the amount of income. So if your income, by the way, on that note of job, let me just say something else on this, not to get too crazy with details, but if you don't have a steady income, so if you started a job recently, less than 2 years ago, it could be okay. It's just that you're gonna have to document, your longer history, showing that you were at a previous job, then you left that job, went to a new job. But typically speaking, you want to have at least a 2-year history of employment to be in safe harbor. Okay, otherwise you can still get a mortgage. It's just that once you get into that, you just got a job 2 months ago situation, and before that you were not employed at all for a long time, that could be an issue. The banks may want you to wait a little bit. But again, if you're in a job for 2 years, you should be good. 2 years and then into 6 months, it gets a little more complicated. It's possible. Talk to your lender. They'll kind of guide you as to how to best approach a situation like that. As far as your income, banks want to see that you have income, a certain amount of income, depending on the amount of money that you're looking to borrow. So on a mortgage, typically banks don't want to see that more than 40% of your monthly gross income is going to pay your liabilities. So without going and using this calculator, because I don't want to use it right now, I'm going to make it real simple. If you make $10,000 a month, or if it's multiple people applying for a loan, multiple people can make combined income of whatever. In this example, to keep it simple, $10,000 a month gross income. So before taxes, okay, so you don't have to worry about taxes. $10,000 a month income. So with that income, a bank is going to be okay with you having a total of $4,000 in monthly minimum payments on your liabilities. And that just means that when the bank adds up all the minimum payments on your credit cards, your student loans, your automobile payments, any kind of loan that you have that would show up in a credit report, and any type of 401k loan, although depending on how you can document that, you may be able to get around that if you have the ability to kind of just like repay that back at any time, should you need to. But any kind of other situation that is not documented on the credit report but is a loan that you have, that you should be forthcoming to the lender and disclose that, because they need to establish what's called a debt-to-income ratio. Debt-to-income ratio is simply a mathematical ratio, percentage that banks use to evaluate and kind of like give you like an assessment as to your ability to afford something. So in this case, your future mortgage payments, throw that in there, whatever they're going to be, you have to estimate that. Your future property tax payments, and this is all monthly numbers, okay? Monthly figures. Future, if you're buying a condo, association fees, and of course, like I said before, anything that's going to show in a credit report, and anything that is a monthly installment, a monthly payment, monthly liability, credit cards, auto loans, etc., etc. Now, when you add all this up, your debts cannot be more than 40% of your total monthly income. So if your total monthly income is $10,000, your monthly liabilities should not exceed $4,000. Now, I say that, but make no mistake, you definitely can get a mortgage if you exceed the debt-to-income ratio of 40%. I just said 40% because if you have a debt-to-income ratio of 40%, generally speaking, you're going to be in safe harbor, meaning you're going to clear the guideline for most lenders. Depending on how conservative they are, most lenders are going to be okay with a 40% debt-to-income ratio. Now, as an example, if you have a 55% debt-to-income ratio or a 60% debt-to-income ratio, or maybe 70%, that means that you make $10,000 a month and your future proposed mortgage plus your current liabilities are going to be $7,000 a month. Yeah, you still make more than your liabilities, but your debt-to-income ratio, 7,000 into 10,000, that's 70%. And remember, we're talking about gross monthly income here. So the banks know that your debt-to-income ratio at 70%, that's just way too tight. You know, you're not going to have any breathing room whatsoever. And don't forget, I didn't mention it, but these income figures, this debt-to-income ratio, I should say, does not factor in the cost of utilities, your cable, recreation expenses, food expenses, or any other type of transportation expenses. It doesn't cover any of that. This is just like what I said: credit cards, auto loans, stuff that's gonna show up on your credit report. So be mindful of that. So obviously, how do you put yourself in a position where you can improve your chances of getting a mortgage or getting a large enough mortgage to get the house that you want based on the down payment that you have? Well, if you want to maximize your borrowing power or your purchasing power, you definitely want to not have as much outstanding debt. So keep your credit balances as low as possible. Common sense, right? But it's important because the lower you can keep your credit card balances, as an example, in relation to your credit limits, the better your credit rating is going to be. In addition to having a good debt-to-income ratio impact, you're also going to have a positive impact on your credit score. Part of what goes into a credit score is how overextended are you. So if you owe $5,000 in credit card debt, but your total credit limits are like $30,000, you're still going to have a very good credit score as long as you are making your payments on time and don't have a history of late payments or any major default or derogatory events like a bankruptcy or judgment or anything like that, or any collections. Make sure that you pay all your medical bills and that anything that could show up on a credit report is resolved or fixed or corrected in advance of you applying. Otherwise, it's just going to cause more stress if the bank finds out about certain things and you don't know about it, and now it causes delays and you might be denied a loan, or it might just delay the whole process, and it could jeopardize your ability to get a house because you won't be able to close in time, and it just adds a whole layer of stress that can be more easily avoided if you deal with these things in advance on your own. And this is kind of the purpose of this video, is just for you to be aware of some of these things that banks are going to look at. so that you can almost qualify yourself in advance, so that when you go to the bank, yeah, there may be some things that you didn't think about, but you kind of hit a lot of the major parts: the down payment, your income, your job, your credit score. Get a copy of your credit report, by the way. I recommend that, just so that you could see your credit score, where you're at, and just so you can see your liabilities, see if there are any mistakes on there that you maybe need to correct, or maybe there's not a mistake. Maybe you do have a collection, an old medical collection with a dentist from a couple of years ago. They didn't send you the bill, but the secretary at the dentist's office put it down with the credit bureaus that you didn't pay. There are a lot of mix-ups. There's a lot of human error that can happen, and you want to make sure that you see your credit report before the banks do. There's I believe a credit reporting agency company. I think it's called annualcreditreport.com. Don't quote me on that. Look them up. I believe you can get one for free with that particular company, and you can use that to see your credit score and see all your liabilities, your payment history, if you've been late, who you owe, what you owe. Basically, the entire history that a bank is going to look at, which again, key, very important to know that before the bank does, so that you can address as much as you can in advance. And the other thing is, where do you get a mortgage? Where do you go? There's a lot of, you can go online and have a million places to go to get a mortgage. What I would suggest to you, I'm not going to recommend a specific company or a bank, but start with your primary bank. So wherever you have your primary bank accounts, start there. Remember, most of the mortgages that people are going to wind up getting are offered at most major banks. Now, there are some mortgage products out there that are more niche products, more limited products, specialized products that some banks don't have and some banks do, and that kind of just varies. But for the most part, if you go to any of the major banks, you're typically going to find that they're going to have the main mortgage products that most people are going to wind up getting. So definitely go there. So your typical fixed rate mortgage, 30-year fixed, as opposed to an adjustable rate mortgage that's adjustable. If you just want the plain vanilla mortgage, go to your primary lender, see what they offer. And again, if you do happen to fall into a specialized category where you can benefit from a very limited mortgage product that not a lot of lenders have, then at that point, the lender might let you know in advance, hey, we don't offer this product, but these other type of lenders offer no money down financing for people like you buying in a certain area. You may qualify for special financing, down payment assistance, whatever the case may be. They will help you out with that. And if they don't offer that up, definitely ask, hey, are there any special programs that I might benefit from? Or let them guide you and help you. You don't need to be the expert, but you do want to be aware of some of these major key points that I'm notifying you about, so that you don't go in there and get blindsided with things left and right. As far as interest rates, again, I'm not going to tell you what the interest rate is. It fluctuates every day, lender to lender, but for the most part, you're not going to find large variations in interest rates. Okay, that doesn't happen anymore. And if you go to a big lender A or big lender B, I'm not going to name names, they're roughly going to be the same as far as like interest rate. So you can definitely feel free to shop around. That's up to you. Just keep in mind, every time you shop around, just because you're asking for a rate over the phone or on the internet and you're looking at it, that doesn't mean that that's the rate you're going to get, because the rates fluctuate. And by the time you actually apply and go through the entire process, which could take weeks to go through, you might qualify for a different interest rate, or the market might just change on its own. And really, you almost can't measure or base any decision on an interest rate that you see, before you even apply. So just be mindful of that. I would try to go with a lender that you know, and also one step further, go with a lender that also has somebody that you feel comfortable working with. A representative that works for a lender that does mortgages, that is going to be responsive to you and is going to help you answer all your questions. That's very important to reduce the stress, to work with somebody that knows what they're doing, that you have confidence with, that if you have any questions, you can get a hold of them. You can email them, whatever the case may be, text them, however you want to do it with them. They should be responsive with you, and you should have a good relationship with them, a good comfortable feeling with them, because you're going to be working with them and they're going to be handling and guiding you through what will most likely be, for most people, the largest transaction of someone's life. Okay, very few people finance anything bigger than a mortgage. So in closing, once again, guys, make sure to prioritize the reasons for choosing a lender. Make sure you have a trusted lender, a person that works with the lender that you trust or feel comfortable with. They're knowledgeable, responsive to your questions, and move forward. Definitely don't postpone buying a property, because with all the bad things that are happening today, there's an argument to be made that if you have a stable job, if you have stable income, okay, not everybody's losing their jobs and having problems. There are some sectors of the economy, if you're a teacher, if you're a government worker, and other situations, if you're stable in your income and your job, and you want to settle down somewhere, and you fit the profile of somebody that really would benefit from owning a home as opposed to renting, because you still got to pay no matter what, whether it's a mortgage or rent, you got to pay. I would say definitely consider getting a mortgage and buying a property in this market. Rates have never been lower. We're at historic lows, so go for it. So with that said, guys, thank you for watching this video, and I will see you in the next one. Take care.